Today I'm not in the studios, and this is that time of the day when we usually talk markets. But today what we'll do is we've got the top team of Nomura joining us on the show when they've come out with their Outlook 2018. We'll discuss markets with Sion, and we'll discuss macros with Vivek, and of course external factors on Indian forex and policy side with Craig also joining us. Sion, I'll start with you. You come out with a very interesting note, a detailed one. We were talking about it earlier as well, where you make a hypothesis that we are heading towards, say, 12,000 or thereabout on the Nifty, and this will be backed by earnings rebound. Now, earnings rebound has been spoken about for quite some time now, at least 4 years. But every time we talk about it, by the second half of the year, the earnings need to be downgraded on the lower side. How is it different this time around, in your view?
Yeah, thanks. So I think you're right. We have seen almost 10 to 15% reduction in earnings, the consensus estimate through the year over the last 3 years. I think this is a typical business cycle which is kind of playing out since 2007, when the corporate earnings to GDP ratio was actually one of the highest, and from there on it has consistently fallen till fiscal 2017. So what we are seeing today is the corporate margins, the EBITDA margins of the corporates, the ROEs are at an all-time low. And we have seen a lot of purging in the system already happening. For instance, we have seen consolidation happening in the telecom industry. We have seen new set of players emerging in the infrastructure space. You're aware of, significant amount of provisioning being made by banks. So a lot of cleanup has happened. Now from here on, I think on this slate, we should start seeing earnings growth. And in fact, if you look at our estimates between fiscal 17 to fiscal 19, we are essentially talking about around 13-14% growth this year in fiscal 18, and then it's accelerating to almost 23-24% growth in fiscal 19. And a large part of this growth is actually driven by banks, where we expect most of the asset quality issues being behind us. Provisionings would start coming down going into fiscal 19. Credit growth should start to pick up. We see growth in autos and oil and gas space. So these are the sectors which are going to drive growth. So bottoms up also we get that confidence. And I think we can't keep earnings suppressed, ROE suppressed for a long time. And in our model, we have seen a very strong inverse correlation between earnings to GDP ratio and the following 5 years earnings CAGR. And based on that, we think we are in for a multi-year earnings growth, which is going to last beyond fiscal 20.
So your note indicates towards a 20% kind of a earnings growth, which can be spread over the next 5-year period. Are you convinced, looking at the quality of earnings which started coming in the second quarter? And also talk to us about what are the sectors, or for indicative purposes, the Nifty components which will lead this recovery in your view?
So yeah, we have seen a lot of disruptions, right? We had demonetization in the third quarter last fiscal year. It had lingering effects. Then we had GST coming, and it also had lingering effects even in the second quarter. Second quarter was better than the first quarter, so there is definitely a recovery. We are expecting it to even improve in the third quarter. In fact, if I look at the estimates, the second half expects almost 36% growth over the first half. So there is going to be a gradual recovery that we are expecting that will continue in the subsequent quarters. It's early days, right? So much of disruption has happened, and the recovery is a gradual process. So I can't say that we have very strong signs, but early signs are definitely visible. And as I mentioned to you, the components of the Nifty, right? The banking sector, the financial sector is the one which will actually lead a large part of this earnings growth that we are talking about, followed by autos and oil and gas.
Right. Let me also play the devil's advocate for a moment, because we have seen a good 25-26% rally on the Nifty this year alone. Last 2 years too, we have come higher on the benchmark indices. How much of this good news, in your view, is in the price? And also, do you think that the valuation argument, which may not be hugely in our favor right now, it appears that we are fairly to slightly on the higher side on valuation, as this earnings which you're talking about start coming in, it will get adjusted?
So, valuations, we need to look at it in two ways, I would say. So one is on the expected earnings. So, as you said, like expected earnings never came through. So on expected earnings, markets have been trading at around 17 times or thereabout. So in that context, it doesn't look expensive. But on delivered earnings, on the historical earnings, that is, it is almost at around 21, 22 times earnings, which is similar to the levels we saw in 2007, 2008. But the fact is, we have seen a significant change in the composition of the market. So we see today a lot of profit coming from high quality businesses like the retail banks, staples, consumer staples, autos. So these are the ones which are contributing, which inherently are high PE businesses. So we see the overall market valuation, therefore, looks on the higher side.
Right. Let's talk about the market slightly on a wider frame. A lot of new businesses are getting represented on the exchanges now. Insurance is a theme which has got well discovered. What are your thoughts on some of the new age businesses, asset management, etc.?
So I think that's interesting. So we would see a lot of these businesses, having a very dominant role in the market going forward. Last year, 2000. I mean, if I just look at fiscal 18, the inflows into mutual funds have been unprecedented.
Sure.
Right. In fact, if you analyze the numbers so far, we are almost like what we have seen in the last 10 years put together. So essentially, I think these businesses are seeing a lot of momentum. We are seeing financial savings, right, as a percentage of total savings rising, and that is what is going to drive these businesses. We have gold, real estate, the other fiscal assets which are not looking attractive to us, and I think that's going to be the situation going forward. So I agree with you. We have already seen some of these IPOs coming through, and I think you will see. I expect them to be a greater part of the market on Nifty over the next few years.
There's also a fear in the market that financials, especially private financiers like private sector banks, mainly the retail banks, and then corporate private sector banks are also coming back. NBFCs already have taken a big share of the credit growth. Do you think that now PSUs will come back, and hence the private sector, the rich valuation they commanded for such a long time, is slightly at risk?
Yeah, I mean, within, of course, financials is a large space. So, within that, I think we have a slightly conservative view as far as the NBFCs, and particularly the housing finance segment is concerned. I think the easy liquidity and, the rates were lower for them, so they could borrow at a cheaper rate. So I think that environment is changing at the margin. Cost of funds are going to go up. And at the same time, as you correctly mentioned, with the recapitalization of the PSU banks, they get more ammunition to actually, come and compete with some of these NBFCs who kind of took advantage of the situation. And I agree with you, the valuations have actually moved up. So among financials, I mean, overall, we are overweight, but I think our preference is more towards retail and the corporate banks.
What's your view on energies, especially refining and gas utility base? Because that's also an area where earnings outlook is good, according to your note.
No, we have been extremely positive. Our analyst Anil Sharma has been thumping the table on this for a very, very long time. And I think gas we see as a strong structural story in India for many years to come. So I think that is one space which we continue to remain bullish on. As far as refining and like oil marketing companies are concerned, I think there also we have seen a good progress in terms of the no government interventions so far, and I think those stocks are not very expensive, right? So on a PE or an EV EBITDA basis, I don't think they pose a lot of the valuations are not very rich. So therefore, at the margin, I think we continue to remain overweight, despite the fact that many of these stocks have done quite well over the last few years.
Let's talk about an area of the market which has become quite hated and ignored, which is pharma, large cap pharma mainly, and IT. Because your presentation also talks about the probability of rupee appreciation the next year. The colleagues had done some work on it. In this light, what's your take on these two sectors, which has seen reduction in ownership from the institutional side, at least in the last 1.5 years?
Yeah, I think it makes sense to look at it because these sectors have corrected or underperformed. But we continue to go with an underweight stance on IT services. The simple reason is I think there are some major structural changes which are happening, and Indian companies are not geared up to kind of participate in the new areas of growth. And as Craig would talk about it, I think we have a view of a positive rupee, which also adds pressure to earnings growth. So when we look at the top tier IT companies, we are talking about single digit growth. Valuations have come down, but we are still talking about mid to high teen PE multiple. So it still feels that there is not enough in the growth to justify these valuations, and it can continue to underperform. As far as healthcare is concerned, I think we are seeing pockets where value has emerged. There are a lot of structural issues and rupee appreciation, as you mentioned. But I think the correction has been extremely deep because of FDA issues and other factors. I think in pockets you get an opportunity to buy these names.
Sure.
So that's the reason we have overweight on that sector.
Right. Let's shift focus and talk macros now. Vivek, in your view, what stage of the cycle are we in right now? And how are you, especially after the commentary coming in from RBI, they have one of the best assessments of the state of the economy. What stage of cycle are we in your view?
Right. So I think at the moment, the way Shine pointed out, we are in a sweet spot. Of course, we are at a stage where growth is looking good going ahead. Having said that, inflation is something which is not a worry. Of course, inflation has risen from very low levels, but going ahead it will stabilize. So I consider India at the moment at a very sweet spot. It's in a place where a lot of asset classes should do well. I mean, of course, as we reach towards the later stage of business cycle, worries on inflation, etc., starts developing at that point of time. Bond markets, for example, doesn't do well. But I think we are at a stage where, as Shine pointed out, equities are expected to do well. Craig has a very positive view on FX markets. Even in bond markets, I think a lot of negativity is in the price. What we have seen is really yields have risen, but I think the main reason for recent rise in yields was really the fiscal uncertainty. However, as we go ahead, we should expect incrementally positive news on the fiscal front. Though I would not say that we should see a decent rally in bond markets, but I think even in bond markets, valuations are looking attractive as far as from the carry, as far as the carry and the total return is expected. So I think overall I would consider India in a pretty good sweet spot.
So two macro indicators are extremely important for equities to do well in any economy. One is range bound or low inflation scenario, and yields also should not be very erratic on the higher side or lower side, but in a range. Do you foresee these two to pan out on a reasonably prolonged manner, and hence the case for equities to do well is good? And what's your range?
Oh, absolutely. I think India, first of all, yes, inflation is rising, but we expect inflation to stabilize broadly within RBI's target band. So that should not be a problem as far as inflation is concerned. We expect RBI to remain pretty much on hold. Now, as far as the bond markets are concerned, I think there is enough real yield cushion. For example, if you really look at 1-year T-bill versus inflation, India has one of the highest real yields. Not only that, even if you look from a yield curve perspective, even beyond 1-year T-bill, the 10-year bond versus 1-year T-bill has enough term premium built into the curve. So from here, I expect a pretty much a range bound market. In fact, in Q1, I expect 20-25 basis point of a rally in the first quarter of the next calendar year, which will be the last quarter of fiscal year. And then I expect a consolidated range. So something like 10-year bond yield to probably sustain in a 687% kind of a zone beyond Q1. I would think 80 to 100 basis point of a term premium over policy rate in a stable monetary policy environment, at a stage where inflation is stable, is reasonable to expect.
Right. Also, let's talk about the growth which you guys at Nomura, the team is expecting for the next 1 year, 1 to 2 year time frame, and what are the risks you have also built in to that growth?
So I think, clearly one risk which I worry about most is oil prices. I mean, oil is bad for growth. That means higher inflation in India. It tends to impact India much more than anything else. So oil prices is definitely one risk that I consider. As Other risks, of course, are there that political calendar heats up. We, though not our base case, we believe government will continue with the prudent policy going ahead, and that will help the markets for sure. But in case a populism develop, etc., then that's not necessarily great for the markets. And on the external front, I mean, any just from a growth perspective, if you ask me, I mean, what we have seen is a very gradual policy normalization from the various DM central banks. And I think, and actually we at Nomura think that that will continue, which means that financial conditions will remain easy. It's a Goldilocks kind of a scenario even in the world. If that changes, that maybe create some issues. But these are risks, as I said. A base case still remains that things will be okay.
So, you know, I have always believed that macro developments or indicators are better tracked by you know, the money market rather than the equity market. So are money markets really factoring in reasonable improvement in credit growth? They've already come back to 10% odd levels, but do you think you know, further strengthening of that is possible? A benign inflation environment, all of that money market is already factoring in, you think?
Absolutely, I think so. In fact, we have been calling for steeper curves in India for some time, and I think steepness is a representative of the fact that growth is looking decent going ahead. Inflation, yes, has come back from very low levels, but I think market is broadly expecting a stable monetary policy. We haven't seen any spike in yields, for example, after recent Reserve Bank of India meeting. So Indian markets are commanding some term premium already, and which in a way is a reflection of the fact that things are looking okay in India.
One, you know, quick word on reform process, because you know, as we were talking to Shine as well, that the capex from the you know, private sector is lagging. It's the government which is leading over there. You think reform processes will continue, and what would be the key monitorables from your side over there?
So reform process, this government has done pretty well as far as the reform process is concerned. We have seen them taking big steps in this direction. Of course, there are some operational issues when you take such big steps. For example, GST as one of the big reforms that India has done. But our view is over medium term things will look much okay, and India will start reaping benefits on those fronts. In fact, I mean, if you look purely from a balance sheet perspective as well, and I think Craig can talk about these things. Despite expecting some widening of a current account, for example, going ahead next year, we expect most of it to get enhanced through FDI. So I think things, as far as the macro stability is concerned, things are looking pretty okay. With some help from the global environment and government continuing to do good things, things are looking good for you.
Right, Craig. In fact, I would like to start with you on that point which you know, Vivek made on the forex side. Historically, for last 20 years, the rupee has been depreciating by 5% versus the dollar. But this year, we saw, at least in the first half, there was strength coming back in rupee. And at Nomura, you are making a case that rupee will be in a structural strengthening phase next couple of quarters and maybe 1.5 to 2 years, if I'm not wrong. You think that's a departure from a normal trend, and that is because the growth will rebound in our country versus many other emerging markets?
Yeah, so I mean, we've done at Nomura, we've done a lot of analysis to try and work out the actual productivity growth in India, to try and work out FX valuations of the currency as well. I would say the combination of our positive structural view from our chief India economist Sonal, and of course with our analysis on productivity, we looked at labour market productivity, GDP per capita, but various other measures as well. And the valuations of the currency, it's, in our view, it is still actually undervalued, particularly on a productivity adjusted basis. So I think as you're going through this phase of this cyclical upturn, along with valuations, very favourable valuations, I think the currency can appreciate quite significantly.
Right. In fact, this morning only I was reading a report from Amundi where they were saying that they favour emerging markets, including India, and emerging market currencies have done well. You think that as this space will continue to outperform and India will be part of that, or you think India has the potential to outperform in the emerging market currencies?
I think there is definitely going to be a lot of differentiation going to next year. You know, no matter what, the developed market policy normalization is going to continue. We are going to see balance sheets shrinking, you know, particularly from the Fed. There's the risk that even Bank of Japan might move forward with that as well. So I would say when we do our analysis, particularly let's focus on Asia, where you know most of the inflows have actually gone into bond markets and equities here. It looks to me that the analysis that we've done shows Korea, I would say Taiwan are probably the primary markets which have seen inflows into equities. And whereas the bond markets, it looks like Indonesia, and to some extent Malaysia has actually enjoyed most of the inflows. India, on the other hand, it still looks, partly because of limitations, it still looks like, you know, the ownership levels are relatively small in the bond market. And when I'm looking at the equity market, it's also not standing out as far as you know, Korea and Taiwan is.
Sure. Well, that's also one of the reasons. Of course, government has put curbs on bond market compared to equities, which is relatively more open because there are limits there. Yeah. But the flows have been buoyant, as you just said. What's the outlook? What's your estimate of flows into India from external side compared to other emerging markets in the pack?
Well, it's also a tricky question trying to forecast flows.
Sure.
But I would say at least from what we have on the basic balance front, because we do have the view that oil prices will remain around $65 per barrel on average through 2018. It looks like the basic balance will be in a deficit. So this will be a slight change from last year and the year before, where the basic balance was in surplus. So this is a little bit more tricky, but I would say that overall the growth momentum we're seeing, you know, all the fundamental structural changes, all the reforms, when I'm looking on the fiscal side as well, you know, I think actually on the fiscal side we will have a relatively positive medium-term fiscal consolidation path, which will strengthen market sentiment further. When I look at all of this together, I think the financing will be relatively easy. You know, when I'm trying to look at portfolio flows, it seems to me that the foreign portfolio flows over the past few years has been about $20 billion per year. It wouldn't surprise me if we have something close to that. So I guess my premise is that the overall financing is going to be pretty easy going to next year.
So last, say 1 year back, the macros for Indian economy were looking very good. But now, right now, we are seeing some, surge of yield. Inflation also come back.
Yes.
Crude also have come back, and government has announced mega capex, and hence the chances that the targets on the deficit will get challenged. Do you think foreign investors will take it in the stride and give it up that much of room for going slightly out of the range which they had indicated?
Yeah. Well, I'll be frank. I think we've already gone through a lot of headwinds, and we've gone through them very well. There were concerns about whether growth would even pick up in India, given the first half performance we've seen. I think Q3 GDP changed that expectation, that 6.3% growth. I think there was a lot of concerns about current financing as well. And the reality is, it's still being financed largely by FDI, and of course portfolio inflows are still coming in. There was concerns about fiscal slippage. And then of course, I think people start to view it as not so negative because people are talking about banking sector recapitalization. And then people are obviously following the finance ministry's comments about a medium-term consolidation path. I mean, people are taking it positively. So I would say India's faced a lot of headwinds already. And the bottom line is that we're going to a more positive growth environment. RBI is very credible. I see extreme credibility when I look at the statements because they are recognizing the fiscal slippage risk and they are recognizing the risk of inflation moving higher. So I'd say overall policy credibility is high, growth momentum is really strong.
Right. All right. On that optimistic note, gentlemen, all three of you, I'd like to thank all three of you for giving us time to have this conversation today. Craig, Vivek, Shine. Thank you very much. Guys, with that, it's back to you.